Individual investors often lack the capital to build a perfectly diversified portfolio on their own. But when hundreds of fragmented accounts aggregate their capital, they form a massive, unified block with immense market leverage. This is where the professional asset manager steps in. Their core function is taking custody of this massive pool of funds and directing it to achieve a specific set of return profiles. We call this commingling. By pooling investment capital together, managers can build a highly diversified portfolio of individual assets, primarily stocks and bonds, far more efficiently than an individual could. These capital pools are not deployed randomly. They are governed by strict portfolio objectives that dictate exactly how the manager allocates assets. For instance, a manager might navigate a portfolio specifically toward common stock funds, taxable bond funds, or money market instruments, depending on the client's goals. Because this entire industry is built on handling someone else's money, it operates under intense regulatory scrutiny. Frameworks like the Investment Company Act of 1940 and ERISA set a minimum standard of acceptable practice. Operating within these heavily regulated markets introduces structural rigidities. Compliance, administration, and trading logistics create unavoidable costs that act as a persistent drag on the portfolio's gross returns. To accurately evaluate professional asset management, an analyst has to map the mechanical structures of these investment vehicles, quantify their internal frictions, and rigorously calculate their risk-adjusted outputs. The foundational pricing metric for all pooled investment funds is the net asset value, or NAV. This diagram shows the exact calculation. The NAV is simply the total market value of all investments in the portfolio divided by the number of fund shares outstanding. How this NAV calculation translates into a share price depends entirely on the fund's legal structure, starting with open-end investment companies, which are commonly known as mutual funds. In an open-end mutual fund, the company sells and repurchases shares directly with investors. Because of this direct relationship, the transaction price is mathematically locked to the exact NAV baseline, even as the total number of shares expands and contracts. Closed-end investment companies operate under a completely different set of rules. A closed-end fund issues a fixed number of shares just once. From that point on, those shares trade publicly on a secondary stock exchange. This creates a critical divergence. The fund's NAV is still calculated twice daily based on the underlying assets, but the actual market price is dictated entirely by independent supply and demand on the exchange. This decoupling creates exploitable pricing anomalies. A closed-end fund will frequently trade at a discount or a premium relative to its actual net asset value. Traditional financial media heavily tracks these secondary market fluctuations, monitoring how shifting interest rates push the trading price away from the underlying asset value. A fund's legal structure dictates its pricing physics, entirely independent of how well the underlying stocks or bonds perform. Active management requires structural costs, and these costs act as an inherent mathematical drag on net performance. We refer to this as friction. This waterfall chart displays a fund's gross NAV return. This is a baseline measurement of performance before any fees touch the investor's capital. If you purchase a load fund, you immediately encounter a front-end load. This is a sales commission that can take up to 8.5% of your NAV right off the top. Some funds offer a low load option, usually around 3%. Others use contingent deferred sales loads, or rear-end loads, assessing a penalty if you sell your shares too early, though this penalty declines over time. Initial sales charges are only the entry fee. The long-term friction comes from recurring operational costs, beginning with the annual 12B1 fee. The 12B1 fee allows the fund to pass its ongoing marketing and distribution costs directly to the investor, steadily chipping away at the capital actually working in the market. Add in the base fund management fees and the overall expense ratio, and the gross return continues to shrink. If the manager also engages in high portfolio turnover, constantly buying and selling assets, they compound the problem by generating hidden transaction costs and immediate tax burdens. These cumulative structural frictions are visible in the empirical data of the asset management industry. When you factor in all these fees, actively managed equity and bond funds frequently yield below average returns compared to unmanaged index benchmarks. Before evaluating a manager's stock-picking prowess, an analyst must verify if the generated alpha can mathematically survive the fund's own fee architecture. A manager's explicit mandate is to diversify the portfolio. Proper diversification effectively eliminates unsystematic risk. the specific dangers associated with holding individual companies. Because of this mandate, evaluating a manager on pure absolute returns is flawed. Absolute returns ignore the varying levels of market risk the manager took to achieve that profit. This equation is the Traynor Portfolio Performance Measure. It is the rigorous solution for isolating true managerial skill. The numerator calculates the portfolio's return minus the risk-free rate, isolating the actual risk premium. The denominator is beta. Assuming a fully diversified portfolio, beta accurately measures the systematic risk the manager exposed the capital to. Dividing the risk premium by beta gives us the Traynor value. This metric tells us exactly how much return the manager generated per unit of systematic risk they took on. We use this isolated metric comparatively by plotting the portfolio against aggregate market performance, represented here by the upward-sloping security market line. Comparing a portfolio's Traynor value to the aggregate market determines whether the manager successfully plotted their portfolio above that baseline. True managerial outperformance is strictly defined mathematically. It requires generating a Traynor value high enough to break above the security market line. Attempting to achieve these risk-adjusted returns occurs in an environment highly susceptible to the agency dilemma. Because managers handle other people's money, fee-based compensation structures can tempt them to take undue, uncompensated risks to inflate short-term returns. The industry counters this through strict adherence to codes of conduct and professional standards, such as those upheld by chartered financial analysts. This rigorous standard stands in sharp contrast to the popular financial press, which often rewards the simplistic narrative of chasing raw returns, while ignoring the careful fiduciary math underneath. The ultimate mandate of the manager is complex: determine client risk profiles, maintain strict diversification, administer costs efficiently, and hunt for risk-adjusted superiority. Professional asset management functions as the precise engineering of risk premiums, structured to mathematically offset the impact of fees and regulatory constraints.